All right, I see people joining. For those of you that are joined, thank you for joining us this evening. We're going to give everybody a few more minutes to kind of log on and get situated, and then we'll jump right into today's presentation. Oh. All right. So let's get started here. So, all right, welcome everyone to today's webinar. Today's webinar is the benefits of using self-directed IRAs to invest in real estate. I know this has been a topic that many of our investors have been interested in, and I truly thank you for taking part of your valuable day today and joining us for today's webinar. I hope you find it beneficial. We are very excited to have Kurt Power from Quest Trust as our guest speaker today, who has lots of experience and expertise in this area. We were actually chatting right before the webinar, and he was giving us a lot of great information. So we're very thankful of his time as well. And I know each of you are going to get a lot of benefit from the presentation as well, and added opportunity to ask questions live on today's webinar. So we're very excited about that. Before we get started, I want to go over a couple logistical items. Right now, we do have everyone on mute except the presenters. And so if you have a question as we go through the presentation today, you'll be able to submit your question via the question feature at any time during the presentation. And so Kurt has a lot of content to go through. So we're going to address the questions as we go, if we can. But certainly at the end of the presentation, if there are additional questions, that's your opportunity to ask additional questions. And we are recording today's webinar, so each of you are going to get a link to that recording. I know several folks that registered may not be able to attend live, but they definitely wanted to get the recording, so we will share that recording after this evening. And so before I hand off to Kurt, we do want to do a short intro to Spur Equity as well. So here's today's agenda. Again, really just introductions, and then we're going to hand it off to Kurt, and we have our Q&A and wrap up. So let's start out with introductions. Rav, I'll let you introduce yourself first.
Sounds good. Thanks, Param. And thank you for joining us this evening, guys. My name is Rav Singh, and as you know, I'm the co-founder and principal of Spur Equity. Moved to San Antonio about 15 years ago from Des Moines, Iowa. I'm a licensed commercial real estate broker in Texas and earned my CCM designation over 9 years ago. For the last 14 years, my main focus has been brokering hotels and investment properties. And while I find these great investments for my clients all over Texas and beyond, for myself and my family, I've really focused my own investments in the multifamily properties, specifically apartments, because I find this to be the most recession-resistant asset class around. So very excited today to hear what Kurt has to say regarding how to invest with self-directed IRA funds, because that's one of the topics that we hear a lot from our investors. And so super excited to hear what he has to say today.
Great. And good evening, everyone. My name is Param Singh, so I'm the other co-founder and principal of Spur Equity. I'm originally from the East Coast, but I've been in San Antonio for the last 15 years with my wife and 3 children. From a career standpoint, I'm a director at a specialized consulting practice within a global IT and management consulting firm. Been managing sales, delivery, and pipeline of that part of the business for over 13 years now, and been working in management consulting for over 20 years. From an investment standpoint, Rav and I individually started investing in real estate over 15 years ago in a variety of different real estate classes and assets, including single family, small multifamily, and commercial real estate. And then Rav and I decided to join forces a little over 4 years ago and start Spur Equity and focus mostly on multifamily investments. As he mentioned, one of the safest, asset classes that we found. So with the success of that, as independent rental owners, we are now utilizing that expertise to syndicate large multifamily projects, allowing our investor partners to be able to grow their own wealth through that same kind of proven strategic multifamily investment model. So now that we've owned and manage now over 1,100 units across Texas and the Florida markets. So to close out the introduction on Spur Equity, just want to mention a little bit more about what we do in our preferred space of multifamily investments. We try to focus on short to midterm hold value-add investments. We're not looking at any long-term hold products because our focus is really growing wealth. And so that short to midterm hold, 3 to 5 years, seems to be the best model for that. And we don't look for distressed properties, but rather stabilized properties that are generally generating cash flow from day one. And we look for opportunities to increase that cash flow, which will in turn increase the overall value of the property as well. We try to focus on properties with 100 or more units as a guideline, just to give us maximum efficiency with payroll and resources and other expenses, and truly lets us take advantage of economies of scale. And then through this whole model and this proven approach, our goal is really to maximize that return on investment for our investors through consistent cash flow disbursements and profits from the ultimate sale of the property. And so another one of the goals that we, Rav and I have, for our investors is to educate our partners and investors on different avenues and aspects around investments. And so we like to partner with those that have that similar goal, which is, why we're very excited to have Kurt Power of Quest Trust with us today to present on self-directed IRAs to invest in real estate. So a little bit of intro to Kurt, and Kurt, I'll let you provide some detail after I hand off to you. But Kurt is a self-directed IRA specialist with Quest Trust Company, which is headquartered in Houston, Texas, and has become one of the leading IRA custodian companies in the country. Quest has nearly 20 years of experience in this space, have over 20,000 satisfied clients, and one of the highest levels of customer service. And quite frankly, our experience has been one of the fastest processes that I've seen with regards to working with deploying these IRA funds into syndication projects. So they've actually helped us out quite a bit, or helped our investors out quite a bit in funding syndication projects through our investors' IRAs. So Kurt, we want to welcome you to our webinar series and thank you for your time and willingness to share your knowledge and expertise with us today. And with that, I'm going to hand off to you and let you drive the presentation.
Awesome. Thank you guys very much. I appreciate it. Been looking forward to tonight for quite some time. So want to start off, we'll talk a little bit about Quest Trust Company. Obviously, we'll talk about what a self-directed IRA is, the many accounts at Quest that you can use to self-direct. And then you'll get to learn a little bit about myself as well. So I'm going to share my screen. All right. Does that look okay, guys?
Looks good.
All right. So I'm going to look at this screen so you see the side of my face, but I'm with you guys. So what we're going to talk about tonight is real estate investing tax-free with self-directed IRAs, and how this can be potentially your number one source to build true tax-free wealth. So as they introduced, my name is Kurt Power. I'm an IRA specialist with Quest Trust Company. I've been with Quest since July of last year, but I've been in real estate in some capacity for about the past 7 years. Prior to my experience in real estate, I got my start in my career in the fitness industry. And while on the surface that may not be related to real estate, the very important thing that I learned in fitness was how to be an entrepreneur. When you're starting out your career in fitness as a personal trainer, no matter what the role is, you got to learn how to hustle. You got to learn how to network. You got to learn how to build your own business to ensure your success. So I learned very, very early on the value of networking and building relationships. And that entrepreneurial spirit is what led me to real estate, where in 2015, I helped build a company in Kansas City, Missouri called Think Realty, which is now the world's largest media platform for real estate investors. Learning how to build a business that is sustainable and successful Very, very important. You learn all of the ups and downs, the pitfalls of building a business, and you learn to rely on those relationships, and you never sabotage a relationship because you never know when they can come back to help you. I moved to Houston in 2019 to be the Vice President of Investor Relations with Pinnacle Storage Properties here in Houston, a self-storage syndicator where I personally managed $35 million of private equity, $110 million of self-storage. So the things that I really learned at Pinnacle, I learned about underwriting, I learned about pro formas, but the biggest thing that I learned was the investor mindset and what it is that makes a good deal for a real estate investor, what they look for. But the thing that I really took away from Pinnacle was about 30% of the investors that we had were using a self-directed IRA. You couple that interest with where I believe the market is going, I think self-directed IRAs are going to be one of the biggest booms in real estate over the next 10 years. I think the pandemic accelerated that with people taking early retirement, furloughs, et cetera. I think people are wanting to take much more control of their destiny. At Quest, I get to do the things I love to do. I get to be an entrepreneur. I get to network and build relationships. I get to help people. And I really get to play a small part with helping people set up IRAs, move their funds over, explain the investment process, play a small role in their overall success and helping them achieve their retirement dreams. So Quest is renowned in the industry for the world famous, world-class customer service that we provide our clients. We are also very well renowned for the highly trained, educated staff that we have that starts all the way at the top with our executive team down to the people that are answering the phone every day. We take education very seriously because many of us are investors ourselves. So we got to stay in front of things to know what we can do and can't do so that we can then better communicate that to our clients. One of the things that truly sets us apart from a custodian standpoint is our fast processing times. When you establish an account at Quest, it will be open in 24 to 48 hours. Fastest in the industry, bar none. When you have an account that's funded and you filled out your investment paperwork, as the gentleman mentioned, we can fund your investment in 24 to 48 hours. That's critical if you're an investor. It's critical if you're the guy raising money so that you don't lose the deal. So Quest takes that very seriously. We're fast, we're accurate, and we like to have fun while we do this. So I'll leave you with this before I jump into the presentation. I believe very strongly that individuals want to do business with people that they like, trust, and respect. And I believe as we go through this presentation, you will like, trust, and respect Quest Trust Company and want to do business with us. So, disclaimer, it's the fun part, guys. I'm not a CPA, I'm not an attorney. Nobody at Quest, myself included, can provide any kind of tax, legal, investment, structuring advice. We can't endorse any products, services, investments of any type. Very simply put, guys, do the due diligence. You are the fiduciary to your IRA. So it's imperative that you vet your deals. And you not only do due diligence and vet your deals, but you do due diligence on people that will be involved in the investment with you, whether you're partnering, loaning money, entering into syndications, whatever it is. Understand and know the people that you're going to be doing business with. Consult your advisors, tax attorneys, CPAs, your trusted people before you enter into any investment. So who is Quest? We are the largest self-directed IRA custodian in Texas and the fastest growing in the US. We have just over 22,000 active investor clients, and we currently hold $2 billion in assets under administration. We have 3 offices. I'm in Houston, which is our headquarters. We also have fully staffed functioning offices in Dallas and in Austin. About 112 employees, 34 of which are certified IRA services professionals. So we are the best of the best when it comes to IRAs. And that track record will speak for itself. We also have about $350 million in undirected cash. What does that mean? We literally have $350 million just sitting here, just waiting to be deployed. So this is an important slide, especially if you're new to self-directed IRAs. If you're familiar with IRAs, just bear with me. This may be a bit remedial, but I know there are people on here that don't even know what an IRA is, let alone a self-directed IRA. It's important to know that a self-directed IRA is not a type of IRA. It's just a marketing term, but it means exactly what it says, self-directed. Again, you're the fiduciary. You're picking the investments and where you want your funds to go. There's no legal distinction between the IRAs held at Quest and an IRA held at Charles Schwab or Fidelity. It's the same traditional IRA, the same Roth IRA, et cetera. What's the difference? The difference lies in what you can invest in with that account. At Charles Schwab and Fidelity, they're doing public assets, stocks, bonds, mutual funds. You have an IRA at Quest, you can now invest in private investments, things like real estate, promissory notes, private placements, land trusts, oil and gas. Runs the gamut of what you can do with the account. So key takeaway from this, self-directed IRA is not a type of IRA. It is just a marketing term. So what are the benefits of a self-directed IRA? The first one is diversification. When we talk about diversification, what we mean is spreading your risk. If all you have in your portfolio is a bunch of mutual funds, I wouldn't say you're diversified. I would say you have a lot of mutual funds. The idea of diversification, ideally, you can have both. You have your public investments at Charles Schwab and Fidelity. You have your private investments with a custodian like Quest. This will allow you to not only have diversification, but it's going to be able to allow you to better navigate any kind of market volatility, like we just experienced in the last year with the stock market going like this. If we have some stable assets on the other side of our portfolio, we're better prepared and better able to withstand the volatility that will inevitably happen at some point. Tax savings. Purpose of an IRA, the incentive was the tax benefits. Depending on the type of account you have, you may qualify for a tax deduction on your contribution. And depending on the account you have, the earnings are going to grow tax deferred or tax free. You're not going to be paying taxes on your earnings as it comes back to your IRA. You're paying it down the road in retirement. So obvious tax shelter and obvious tax benefits to utilizing an IRA. This one is one that I think gets overlooked. Investing in what you know best, or we call it control. Control of your investments. You get to invest in the things that you know very best. If you'd like single family fix and flips, if you like buy and hold rentals, if you're like me, you like to loan money out passively to borrowers or invest in multifamily, self-storage, apartments, whatever your area of expertise is, you get to invest literally in the things that you know the very best. And lastly, social investing. We talk about social investing. This is another category that can somewhat get overlooked, but I think is very important, especially when we're talking about leaving a legacy. I think we all innately want to leave the world a better place when we pass on. This is a great way of doing it, but also in the here and now, if we're doing fix and flips, if we're rebuilding neighborhoods, not only are we providing local contractors, local construction workers with opportunity and jobs, but think of that family that's going to be renting from us. We're giving them a second chance at having a roof over their head. So while diversification, tax savings, control are very important, I think you could argue very effectively that the impact you can have in your community and on human life is just as important. So at Quest, we have 7 types of accounts that can be self-directed. And we break them down into 3 categories. We have our personal plans, the traditional and Roth IRA, our employer plans, the SEP, Simple, and Solo 401k. And lastly, our specialty plans, the health savings account and Coverdale education savings account. Our personal plans are probably the most popular. I don't mean popular like they're everybody's favorite. I say popular because these are the ones most commonly that people have. When somebody has a traditional IRA, typically they have rolled over their old retirement plan, their 401k, 403b, 457, whatever that plan is, it rolls over into a pre-tax IRA, in this case, the traditional. And again, you may qualify for a tax deduction on your contribution, but your earnings are going to go tax deferred. Tax deferred. So when you turn 59 and a half and you begin taking distributions, that is the time in which you'll begin paying taxes. So if I have a house that I bought for $100,000 in my IRA and I'm getting $12,000 a year, I'm not paying taxes now. It's accumulating in that IRA. When I take distributions in the future, that amount's added to my modified adjusted gross income, tax is ordinary income. But what if we did that same investment and the earnings could grow completely tax-free? Think about that. $100,000 property that's cash flowing $12,000 a year and is completely tax-free. My friends, the Roth IRA is one of the true pillars of wealth building, and not just for yourself, but we're talking about legacy generational wealth building. The Roth IRA is one of those pillars. Reason for that is it's an after-tax account. So the money I contribute to the Roth, I've already paid taxes on. And when I invest those dollars and I grow earnings, as long as I've had the account open for 5 tax years, I reach the age of 59 and a half years old, I can pull those earnings out completely tax-free. And when I pass away, my heirs, my beneficiaries will get that same tax and penalty-free benefit. Our employer plans, the
Quick question, if you don't mind. We just got an email. So on that Roth IRA, since it's so important, you just talked about it. Are there any limits in regards to the Roth IRA that our investors can transfer into a Roth IRA?
Never a limit on transfers for any account. You can transfer in $10, you can transfer in $10 million. There's no cap on transfers. There's no cap on earnings. The one thing that an IRA has a cap on is how much I can personally contribute to that account.
Right.
So in the case of the traditional and the Roth, if I'm under the age of 50 years old, my max contribution, $6,000 per year. If I'm over 50, I get a catch-up contribution of $1,000. So the max I can contribute is $7,000. I can roll over from my old retirement plan $500,000. I can transfer in $500,000 from an IRA at Charles Schwab or Fidelity.
But does that money need to be in a Roth IRA when you transfer into this Roth IRA?
Yes, it has to be Roth to Roth because it's going to go post-tax to post-tax. And if it's in a traditional or a pre-tax account, it would need to go pre-tax to pre-tax. Right. And it goes IRA to IRA, like account, like account. Okay. Reason that's important is the custodian, Quest, if you're moving funds to Quest, we will initiate the transfer as a free service. We do that so that the customer, the client, there's no penalty for early withdrawal. There's no taxation because it's not touching them personally. It's going from one custodian to us.
Gotcha. Thanks.
No problem. The employer plans, the SEP, Simple Solo 401k, these are for individuals who are self-employed. And we see with the SEP IRA, maybe it's an individual who is self-employed and he's the employer and the employee. Maybe he's got a small lawn care business. This functions the same way as a traditional IRA in that it grows tax deferred, but you can make much, much larger contributions. You can contribute up to $58,000 to a SEP IRA, or 25%, up to 25% of what you pay yourself, whichever of those two is less. So you see much larger contributions, but it's basically a traditional IRA with much, much larger contribution limits. A simple IRA is something that we see for doctors, dentists, people with small office practices. And again, much larger contribution limits. We don't see a ton of simple IRAs. They do exist, and it really is that niche crowd of dentists, doctors, people with small practices. Solo 401k, this type of account is its own unique animal. It is a very, very powerful account for people who are truly self-employed with no employees. There's specific criteria that one must meet to even have a solo 401k, and that's per the IRS. And we have solo 401k experts on staff at Quest that really their sole responsibility is doing solo 401k consultations because it's a very powerful account. And as our president, Nathan Long, likes to say, with great power, it's Spider-Man philosophy, with great power comes great responsibility. This is an account that is truly up to the individual to maintain. Quest has no custodial oversight over it. But if used effectively, very, very powerful account. So if the employer plans meet your criteria as a self-employed individual, let's talk about that, because each one of these has their own unique features to them. We want to make sure it's the right one for you. Specialty plans, the health savings account is maybe the favorite account we have at Quest, and we call it the best of both worlds. And what we mean by that is my contribution to a health savings account is tax deductible. And when I use that money for qualified medical expenses, that money is completely tax-free when I use it for qualified medical expenses. Things like doctor visits, surgeries, eyeglasses, dentist, even alternative treatments like chiropractic and acupuncture qualify as a qualified medical expense that you can use completely tax-free. Coverdale Education Savings Account. This is something that people can use for their children. They can begin funding at the day the child is born until the day they turn 18. It's different than the 529 plan for a few different reasons. Number one, this account can be self-directed. You can purchase real estate with a Coverdale education account. Two, you get to use that money right now. If you have a child that's in kindergarten through high school, college, you can use that money completely tax-free for qualified education expenses. Things like tuition, school supplies, room and board, uniforms if they go to a private school. All could be used completely tax-free. And a big one, especially in the age of COVID, with a lot of people still doing homeschooling, you can even pay for your Wi-Fi completely tax-free with the Coverdale Education Savings Account. So key takeaway from this, guys, all of these accounts can be self-directed individually, or they can be partnered together. You can actually partner these accounts together. When you partner, you have to understand that your IRA has its own name. Quest Trust Company, FBO, which means for the benefit of John Smith, IRA 12345. That is the IRA's name. So if it's me, Quest Trust Company, FBO, Kurt Power, IRA, whatever my account number is. That's the legal name of my IRA. That's the investor in this, whether I'm buying property, loaning money, entering into syndications. When we partner IRAs together, same vesting, Quest Trust Company, FBO, John Smith, Roth, account number, as to an undivided interest, 50%. This means this is how much this IRA owns in this investment, 50%, 60%, 70, whatever the number is. And then here's my partner, Quest Trust Company, FBO, Jane Smith, IRA account number as to an undivided 50% interest. This is important when we partner, that we understand that this is how profit is split. If I have a single family home making $1,000 a month cash flow, 50-50 split. But if my profit is split, guess what else is split? My expenses. My IRA owns the property. My IRA has to pay the expenses. And if I'm partnering, it has to be paid according to my level of ownership in that deal.
Kurt, so are you saying that two partners separately can come in and purchase one property together?
Yeah, we've seen deals with as many as 9 investors in it using their IRAs, all at varying levels of undivided interest. It can be 50-50, or if you bring in 3 or 4 people, whatever those splits are, we can partner our IRAs together. We see this commonly with people who are just starting out. Maybe they don't have a large IRA.
Right.
This allows them to get a piece of ownership. So at Quest, a lot of us like to partner our IRAs together. We see clients that like to partner their IRAs together. They all get a piece of undivided interest, which is going to help their account grow faster than if they're just making contributions on an annual basis. So
even for, so sorry, Kurt, from a, like for a syndication, for example, we're talking about, a minimum buy-in of 100,000 or 150,000, so they can partner 2 or 3, as long as they have all have accounts at Quest, they partner those together to purchase one kind of buy-in to a syndication, right?
They can, and
okay.
Where this comes into play as it relates to syndications, it really is at the managing member's discretion. We've seen it both ways. We've seen managing members that don't mind. Say my buy-in is 50,000 or 100,000. Some syndicators don't mind if it takes 3 IRAs or 4 IRAs to get that one share.
Yeah.
I've seen other syndicators where they don't like that because it become a bookkeeping nightmare when they're splitting off cash flow or paying dividend to the investor, maybe writing several different checks. I've seen it done both ways. It really is at the discretion of that managing member if they will allow, in the case.
I see. So from a subscription standpoint, it's still split.
Right.
Gotcha. Okay.
Yep. It'll Understood. Still show on your subscription agreement where you have all your investors. It'll say Quest Trust Company, FBO, Kurt Power, IRA 1345, as to an undivided interest of whatever that percentage is.
Understood.
So on. Yep. And like I said, seen it done both ways. Seen some syndicators that don't mind. I've seen some that would prefer just to have the one investor because for bookkeeping and dividend split, it's much easier for them. So the IRS does put some restrictions on IRAs. They put people, transaction, and investment restrictions. So we'll cover this now so you know really what we're talking about here is who are the people that are restricted from doing business with the IRA? What are those transactions and what are those investments? Who can I not work with? What transaction can I not do? What can I not invest in? So the people restrictions, what we're talking about here is what are called disqualified persons. Disqualified persons. These are people that cannot benefit from or enter into transactions, not only with my IRA, but any other qualified retirement plan. So if we break this down, we look at it like this. There's you, Mr. Tax-paying citizen. You got a pulse, a heartbeat, wife, kids, friends, credit score. And then over here, we got Mr. IRA. He has none of those things. Mr. IRA has a very lonely existence. No credit score, no family, friends. It's its very own entity. So we have you. You are your very own entity. Your IRA is its very own entity. What does that mean? Very simple, guys. It's a very easy chart to understand who the disqualified persons are. Take a couple seconds, write that down, and we'll move on.
Couldn't get any simpler.
Yeah, this is easy stuff. Anybody can get this just by looking at it. So this big, scary chart, it's very simple. So at Quest, and I'm going to do what we call our little dance here. So I'm going to do it from a sitting position. But we do a lot of traveling at Quest. Internally and externally, we probably do 600 events a year. So consequently, we're in the air a lot. Here's a very easy way to know who the disqualified persons are. These people are you, your spouse, lineal ascendants, lineal descendants, their spouses, companies that they own, control, manage, or are highly compensated by. So once again, who's disqualified? You, your spouse, your lineal ascendants, lineal descendants, parents, grandparents, children, grandchildren, their spouses, and any companies any of those people own, control, manage, or are highly compensated by. Disqualified people cannot do or engage in what are called prohibited transactions, and they are. You cannot buy, sell, trade, loan, extend services, or receive a direct or indirect benefit from the IRA. So what does that mean? My IRA can't go buy a house and then I live in it. I can't buy a house with my IRA in Austin, Texas for my kids going to University of Texas, they can't live in it. They're disqualified. They couldn't even live in the house if they had roommates that were paying the rent. Just because they're not paying the rent does not mean that they are not receiving a direct benefit from my IRA. So we know the people restrictions, we know the transaction restrictions. And there's a plug for a free class that we have online, Prohibited Transactions, an analysis of what not to do with your IRA. Investment restrictions, it's very simple. Life insurance contracts, collectibles. What's a collectible? Artwork, classic cars, antiques, metals, baseball cards, alcohol. That vintage wine collection that you so desperately want can't be paid for with your IRA. And I like to joke with a friend of mine that's into baseball cards and collecting bourbon. It's like, man, if you're using your funds to collect baseball cards and buy booze, we got to have a separate conversation, man. So what can you invest in? We just told you the things you can't invest in. Really anything you can think of that you can take title to. Real estate, single family, foreclosures, commercial property, condos, options, land, tax liens. If I'm doing private entities, I can invest in an LLC, limited partnerships, trusts, joint ventures, promissory notes, secured, unsecured, mortgages, convertible notes, shared appreciation, net profit notes. So as we were talking earlier before we got on here, and as we've gotten to know each other, gentlemen, as we've talked over the last couple of months, when we talk about multifamily investments, when we talk about syndications, we got to talk about something that is not at all intended to scare a prospective investor who wants to use their IRA. It's to make you aware of certain things with the IRA. So an IRA, by definition, again, it's a tax exempt entity by definition. And when I tell you this next piece, it's not contradicting myself. Just need to make sure that you guys understand. Can IRA investments be taxable? Yes. Yes, they can. What we're talking about when it comes to IRAs paying taxes, we're talking about Ubit, unrelated business income tax, or UBI, some people call it. How can I incur Ubit, unrelated business income tax? There's three ways that an IRA can incur Ubit. And Ubit is taxed at the trust rate. It's about 37.4%. If I'm running a business inside of my IRA, I could incur Ubit. Who determines that? The IRS. An example of how a business would incur Ubit, use the example of a church. A church is a nonprofit business, and they have a bookstore selling religious books, religious goods, etc. That ties back directly to the intended purpose of the church. But what happens if I go to church and I'm like, oh, they got a Starbucks in here. They got a McDonald's in here. Popeye's chicken, whatever it is. Church's chicken because it's a church. That has nothing to do with the intended purpose of the church. So the IRS would, in all likelihood, say, hey, you've got a very, very large advantage running a business in a tax-exempt entity versus the franchisee down the street who's paying taxes. They're going to hit you with Ubit, unrelated business income tax. What I'm doing is not related to the business. Think of it in real estate. If I'm doing fix and flips and I'm doing 20, 30, 40, there is no set number. But let's say I'm doing enough to where I'm running a business inside of my IRA. In all likelihood, I'm going to pay Ubit because I have an unfair advantage running a business in a tax exempt entity like an IRA versus the guy down the street who's doing that as his business and paying taxes. If I loan out personal property that is not attached to land, mobile home, jet ski, etc., I would incur Ubit. But when we're talking, so see, owning a business, renting personal property. But if I am investing in debt leverage property, like a syndication, multifamily, apartment, self-storage, I'm not going to incur Ubit. I'm going to incur a subset of Ubit called UDFI, unrelated debt financed income. The way I'm going to incur that, debt financed rental income, debt financed capital gains. What does that mean? Let's say that I've got my IRA invested in self-storage or multifamily, and that property is 60% debt leveraged. 60% of my income that's coming back to me, the investor, if I'm investing in an LLC, we need to make that distinction. If I'm investing in an LLC is a pass-through entity, passing the taxation on to the investors. If I'm 60% debt leveraged, 60% of my income, my earnings, is going to be subject to Ubit. But don't be confused about these. This is not a tax on you personally. It's a tax to the IRA because the IRA is doing the investment. And again, when somebody calls me and they say that they've got to pay Ubit, I tell them, congratulations. You got a great problem. You get to pay taxes. What does that mean? It means you're making money. That's not a problem. Not a problem at all. And Ubit is not a reason to not do an investment inside of an IRA because this is literally the only tax that an IRA is ever subject to. I'm not subject to capital gains. I don't pay taxes on my earnings. I don't have to worry about all the other taxes that me as a living, breathing human being that pays taxes has to pay. City taxes, state taxes, federal, whatever. My IRA is exempt from all of that. Very specific examples: running a business, renting personal property not attached to land, or owning debt leveraged property in my IRA are the only ways I will ever incur Ubit. So again, it's not to make you scared or dissuade you, it's to make you aware of it. So if your IRA pays cash, 100 grand property, I pay 100 grand for it, no tax. I'm not debt leveraged. So there's going to be no Ubit on that. So what's the solution to Ubit, UDFI? Depreciation. We get told so many times that IRAs can't use depreciation. And right here, because the IRA is a tax deferred account, there's no tax benefits such as depreciation. But if my IRA is subject to Ubit, I get to write off expenses and depreciation. It can offset the Ubit tax. That's pretty powerful. You have a competent CPA that understands not only Ubit, but they know the difference between Ubit and UDFI. They understand real estate investments. Take it one step further, they understand IRA real estate investments. That CPA can be invaluable. This is why we encourage our clients and non-clients, whomever is doing real estate investments, to do due diligence and make sure they've got a team in place of a lawyer, tax advisor, CPA, et cetera. Because if you own debt leveraged property, you get to use those depreciation and expenses to offset that taxable liability. Another potential solution: invest in a C Corp. C Corp is not a taxable entity. The last solution, there's one other: loan, don't own, we call it. Loan your money out passively. Now you're not going to be subject to Ubit because, or UDFI even, your borrower could be. Your borrower is the one that's debt leveraged. They're the one taking the loan. So you can mitigate the possibility of Ubit or UDFI if you become the bank, if your IRA becomes the bank and is now loaning to a borrower. They would pay Ubit, not you. Last is a solo 401k. This, again, this is a powerful, powerful account, but it has its own set of problems and solutions. Biggest problem is legitimizing. When I have a solo 401k, I have to legitimize that account in the first year that I have the account open. What's legitimize mean? I've got to make a contribution from the profits of my business in year one. Another problem: Quest has no custodial oversight of a solo 401k. this can become an issue because you as the account holder, you go through a solo 401 consultation. At the end of the day, if you decide it's the account you want, Quest is selling you a set of plan documents. You'll go to a bank and set up the bank account. So you get the checkbook, the EIN number, etc. You are now responsible entirely for all of the reporting, all the tax filing, all the record keeping. Why is that a dangerous responsibility? Because you could very, very easily engage in a prohibited transaction. If I've got a checkbook in my hand for my solo 401k, could I write a check to a disqualified person? Could I write a check to myself? I could. Doesn't mean I will, but I certainly could. So it's a lot of high risk. What a lot of people don't talk about when they talk about solo 401ks or checkbook IRAs, these are the most scrutinized accounts by the IRS. The reason for that is there's no custodial oversight. So when we talk about a checkbook IRA literally means my IRA is funding an entity like an LLC that I manage. I set up a bank account. I now have a checkbook. That's a checkbook IRA. IRA funds an LLC that I manage. I have a checkbook. Why is this dangerous? We talk about the prohibited transactions that we discussed earlier. The biggest one is extension of service. That's a huge issue because extension of service is the most vague prohibited transaction that there is. And that goes back to the disqualified persons. You, your spouse, parents, grandparents, children, grandchildren, their spouses, companies they own, control, manage, or are highly compensated by. And those prohibited transactions, buy, sell, trade, loan, extend service, there's that phrase again, or benefit directly or indirectly from the IRA. If I am the IRA account holder and the manager of my LLC, and I have a checkbook writing checks on behalf of that LLC, that could be deemed an extension of service. And going back to why we take prohibited transactions so seriously is that if you are audited and it's found that you've done a prohibited transaction, it is retroactive to the first day of the year in which that prohibited transaction took place. Do you think the IRS would audit you a month from doing that prohibited transaction? Or does 10 years sound more likely? 10 years. We've seen as many as 15 years that somebody has had to pay taxes and penalties for each year that that transaction was taking place. In many cases, the penalties, the taxation, et cetera, can actually be more than what your total account value is.
Yeah, I'm glad you brought this up, Kurt, because we get these questions a lot, especially around this checkbook IRA, because it sounds so advantageous, right? It sounds like, hey, I got money in hand, I got checkbook in hand, I can fund a transaction. If I see an opportunity, I can fund it, and I don't have to go through this, kind of lengthy process potentially. And we've seen it, we've heard folks talk about it, but I think that, you bring up really good points around, what your IRA can fund these prohibitive transactions. So that layer of custodian oversight is really, a very valuable service, right? To be able to kind of protect against that, right? And I think you mentioned earlier as well, and we've heard this as well, that checkbook IRAs and solo 401ks are in fact very heavily scrutinized, right, by the IRS. So they're watching those like a hawk to make sure that you're not kind of sending out money in the wrong way. So yeah, I mean that we've certainly seen and heard all of the or heard all the advantages, but the flip side of that is really something that needs to be shine a light on. So I'm glad you did that.
And it's interesting because we hear it all the time from people who will say, oh, I talked to so-and-so and I set up 5 LLCs and I got my checkbook IRA. And it's like, how many IRA investments have you ever done? Well, none. And you want to go with the most scrutinized account that there is. In many cases, a checkbook IRA or a solo 401k, which does offer the checkbook, it's really for a very, very small amount of people, very sophisticated investors who know the ins and outs, know the game. Maybe it makes sense for them. It may make sense for an individual down the road when they've done a handful of IRA investments. They know the rules, they understand what they can do and can't do. But aside from just the responsibility aspect of it, you date back to 2015, the IRS is requiring all IRA-owned entity structures to report on the tax document 5498 of those IRA-owned structures. So you can really infer from that that the IRS, to your point, is taking a very hard look at these structures. And generally speaking, it's because somewhere along the way, somebody's done something that's got their attention. So when we talk about investing with IRAs, you look at two stacks, basically. You got this stack over here where you're flying under the radar, you have a level of anonymity, or you're in this stack that we know is going to be an audit trigger. We know they're looking at them. So then the question becomes a matter of risk versus reward, and what side do you want to be on? You know, when you start thinking about the negative potential of a prohibited transaction, having custodial oversight really is not the worst thing in the world.
Yeah, of course. Hey, so I know we're coming up at the top of the hour. We did have a couple of questions that came through. If you want to finish the slide, and I want to kind of direct a couple of these questions towards you.
I'll put a bow on this. So there are advantages to a solo 401k. I don't want it to be all doom and gloom. You do get a checkbook, larger contribution limits. You can loan money to yourself, and you get a UDFI exemption. But as we talked about, if I own debt leveraged property in my IRA, I get to claim depreciation and expenses, so that UDFI can be wilted down significantly, and you have custodial oversight. So as we wind down here, the steps to purchase an asset with a self-directed IRA. Number one, open an account with Quest. It takes 24 to 48 hours to get the account open. As an IRA specialist, I'm going to be your guy helping you open up the account. I'm also going to help you with the funding of the account. Are we contributing? Are we rolling over? Are we transferring? How are we funding it? I will help with that. This is where the entrepreneur in you has to come out, locating your investment. Once you've found that, you complete the very specific direction of investment forms, which gives Quest the legal obligation to fund the investment on behalf of your IRA. So because we don't give tax legal investment advice, guys, we do a ton of education. And the way I look at education is knowledge will eliminate fear. And when you don't have fear, you're going to take massive action. So eliminate the fear, arm yourself with knowledge. We do webinars every week, Tuesday and Thursday at noon. We do $1 trillion investment mixers, the first and fourth Tuesday, fourth Wednesday in the evening. Every Saturday, self-directed Saturday, we have a presentation going on. We also have our free virtual networking happy hours, the first and third Wednesday of every month. This is where you can find partners. This is where you can find deals. This is where you can find money. And it costs you absolutely nothing, whether you're a client or a non-client. Let us help you and provide some education for you along the way. Follow us on Facebook and YouTube. This is Arnold Schwarzenegger, guys, the greatest actor that ever lived. I think we can all agree on that, right? The greatest actor of all time, the greatest bodybuilder of all time, maybe the greatest man that ever lived. I bring up Arnold because of this quote: "The worst I can be is the same as everybody else." I hate that. Why this is important to me, this is the way I've lived my life. I've lived my life intentionally and purposely to be different than my peers, my friends, even my own family members in some cases, because I've always wanted more. And I've realized that real estate can provide whatever that more is. This is a way for me to get there, and this is a way for many people to get there. We know real estate works. We know investing with an IRA works. The question is, how does an individual make it work for them? That's the only question that comes up. We know it works. You guys are living, breathing examples of that. Me as an IRA specialist and a novice investor, I see it for myself as well. Eliminate the fear, take action, and don't be afraid to be different from everybody else, guys.
Love it. That's great.
And last thing here, how do you get a hold of us? email me directly, guys. Kurt.power@questtrust.com. I want to help as many people as possible. Doesn't cost you anything to have a consultation with me. I'd be more than happy to go over your unique situation, answer any questions that you have, help you however I can. We have a live chat feature on our website. You can talk to a live IRA specialist, not a robot. When you call it, when you're on our website during business hours, myself or another IRA specialist is going to be there answering questions. Last one, give us a call, 855-FUN-IRAs, guys. Come join the fun. I look forward to working with you and helping you. And hopefully you've gotten something out of this presentation, and I look forward to answering any questions you guys have.
Great. Thanks, Kurt. That was, yeah, really, really appreciate your time. There's a couple of questions that came up. One is, I think we talk about kind of when to set up the account. You're saying, call us now, set up the account, and hopefully, a lot of our investors that are thinking about this will take you up on that and do that. We do have a lot of investors that they identify a project and then they're like, hey, I want to do that through my IRA, and then like, let me go set up the account, like, and we've all seen the challenges of that. So can you talk a little, I mean, stress the importance of getting that account set up ahead of time?
That is the most critical thing, because you can't have the investment without the account. So setting up the account sets everything else in motion, and it allows Quest and myself to facilitate and help the process go that much more quickly, that much more smoothly and easily. So while your account is open, I'm going to introduce you to the proper transactions department, either in real estate notes or private entities, so that we work on that very specific direction of investment forms. That is important, because the part that's going to take the longest and the part that could potentially make you miss your deal is funding the account. Quest doesn't have control over how long it's going to take that custodian to transfer the funds. Or if you're rolling over an old 401k, in all likelihood, they're going to send you a check via mail. And then you've got to mail the check to Quest. And then there's a 5-day mandatory hold on all bank checks. You can miss your deal in that time frame.
Yep.
So ideally, we get the account set up, you identify the project, we start working on direction of investment and funding simultaneously, so that when we get the paperwork done, funds hit the account, 24 to 48 hours, we can fund the investment. So timing is everything. And it's setting up the account is step one, and maybe the most important, because you got to have that in place to do your investment.
Yeah. And I have to say, we've Rav and I and the Quest team and our investors, some of our investors have seen this firsthand. We have had investors kind of miss the boat on a deal that was really good for them, and they just couldn't do it in time because of the exact scenario that you just mentioned. But in some cases, the Quest team has gone over and beyond and trying to get those investors set up and even release funds early. So, hats off to your team in getting that done. So,
at the very least, if we can provide proof of funds, sometimes that can make all the difference in the world. Like if we're up against a time crunch and we can't release the funds because it's a check, if we can at least provide a proof of funds, that goes a long way and helps you not miss your deal.
Yeah. So I got an interesting question here about crypto's really hot. Can you use self-directed IRAs to purchase cryptocurrency?
So there are some custodians that will allow you to directly take your IRA and purchase crypto. At Quest, we're real estate focused. We're created by real estate investors with real estate in mind. So we do real estate, private companies, notes. And that, because we're so focused on that, that's how our processing times can be faster than everybody else without charging expedited fees. Now, recognizing that crypto is kind of all the rage right now, we get questions about it all the time of, well, how do I do it? We've seen situations where we have the IRA fund an entity like an LLC. Mm-hmm. The caveat at Quest, and something that needs to be discussed very quickly, is Quest doesn't have an issue with you investing in an LLC. We do that hundreds of times a month. We would rather see a layer of separation where you are not the managing member of that entity. So as it relates to buying crypto, the IRA could fund an LLC that a non-disqualified person manages, who's not disqualified. your friend, your brother, your cousin, sister, aunt, uncle, niece, nephew. Somebody that you trust could be the managing member of that LLC. The LLC could then go purchase the cryptocurrency.
Okay.
And when they
Way to
sell it
do it.
off, sell their position, the IRAs, the investor, eventually the IRA is going to get the funds back to it.
Get the returns. Okay, excellent. I have a question about, let's see, are there any limitations on debt leverage? What about personal guarantees? Do the loans have to be non-recourse? What about carve-outs, bad boy carve-outs, I assume?
They have to be non-recourse. When an IRA accepts a loan, the only type of loan that an IRA can accept is non-recourse, with true non-recourse language, meaning there is no personal guarantee, and you haven't extended your credit to the IRA because that's an extension of service, which is a prohibited transaction. We do know several banks that have built their entire business doing non-recourse loans to IRAs. I can share that list with anybody who's interested. I would just put it under the caveat, don't take it as tax legal investment advice. Do your due diligence on each one of these banks to make sure that they are the best fit for you. When I say best fit, you like them, trust them, respect them, and you can meet with them on their terms. Aside from banks, the number one thing that people at Quest use their IRA for is to be the bank.
Mhm.
So you can find other people's IRAs. We talked about it outside of IRAs, OPM, other people's money, and IRAs, it's OPI. We're not talking about the nail polish, we're talking about other people's IRAs. So you can find a lender who will loan you money from their IRA, prove yourself to be a good borrower. You can literally find yourself a lender for life, but it's all non-recourse.
Excellent.
Awesome.
So I have a question. I don't know if, yeah, so for Roth IRAs with Quest, what's yearly fees to hold a Roth IRA with Quest to do that, and I guess roll that over to you guys?
So there's a handful of fees at Quest, and it's, believe it or not, it's the first thing you see on the application is our fee schedule, and you just see a bunch of numbers. Account opening fee of $100. The only other three fees we have, they take effect when you do an investment. When you have our transactions department review your documents, it's $125 to purchase the investment, have that team review all documents and fund your investment. Outgoing wire or check, when money leaves your account to fund the investment, $5 for a check, $30 for a wire. And there's an annual administration fee. This really comes down to how much money somebody's moving over and what the nature of their investment is. It can either be an annual flat fee of $350 per year, or a quarterly fee based on the total account value of cash and assets. This is a place where I can give guidance on that. I want people on the cheapest fee schedule. So when we have our consultations and we figure out, number one, how much is being moved to Quest and what investment are you doing, short-term or long-term, then we can get you on the most effective fee schedule. That's it. That's the fees for Quest. Our average client spends about $400 a year with us.
That's great. So I want to be respectful of your time, of our participants' time. So I'm going to wrap it up here. Rav, unless you have anything you want to, any
No,
question that you want to.
I think one last question that came in is that, if you have a Roth IRA and just a regular IRA, are you paying two fees? Are you paying fees for each?
Yeah, you'd have an account opening fee for both. And then if the traditional IRA and the Roth IRA are doing separate investments, then they have that transaction and admin fee. If they're partnering together, you can split the transaction fee between the two IRAs, but each IRA is going to own an asset. So again, they could both be on different fee schedules depending on how much is in each account, but they both would have an annual fee, either $350 per year or quarterly, depending on what the account value is.
Okay, and I've seen that you guys run specials all the time, especially on your website or other webinars that I've seen that you guys administer. So, is there anything that's going on right now?
Yeah, what I'm offering anybody who signs up for an IRA here is $100 for unlimited accounts for them and their family. So, if you've got an IRA and you've got a spouse can get an IRA, won't cost anything. If you have kids, they can get a Roth IRA or a Coverdale education account, won't cost them anything. $100 for unlimited accounts for you and your family.
That's great. And how long is that for?
Oh, well, let's see here. I didn't really think about that. Let's call it a couple days. So reach out to me, guys. I mean, at the end of the day, I want to help everybody on here. I mean,
Yeah.
it costs nothing to do the consultation. And I firmly believe that if somebody wants to use their IRA to invest, Quest is going to win them over just with good customer service,
Yep.
being attentive, picking up the phone, the non-automated line. You're always going to talk to a real human being when you call Quest. And think about that as a consumer. You know, I have issues all the time with different companies that I work with, and I pick up the phone to call them, and I'm on the phone for 10 minutes trying to get to a real person. I'm so mad I forgot what I even called for.
Yeah.
So we take that very seriously to provide great customer service when things are going well. When things are going bad, guess what, guys? We pick up the phone and we talk to you.
Thank you so much.
That's
Very
great.
welcome, guys.
Kurt, thanks again for your time. I really appreciate all the knowledge that you've shared and your expertise. For everyone on the webinar, I appreciate your time as well. I highly encourage you guys to hit up Quest and their webinars. Rav and I have been attending as well. We're trying to learn as much as we can so we can pass on that knowledge and actually use it for ourselves as well and our own retirement accounts. Please reach out to Kurt directly. There's his email, kurtpower at questtrust.com. Check out their webinars online and educate yourselves on this. This is I think this is a great vehicle for those of you that have invested cash and now you're tapped out because we after you invest in a few projects, this is another vehicle, right? This is another vehicle for us to be able to use and invest in real estate, and I think it's powerful. So let's educate ourselves and see if we can get this set up. So again, with that, again, Kurt, thanks again, and we look forward to future sessions like this, so we can continue that conversation with our investors.
I look forward to it, guys, and I'm looking forward to things kind of coming back to normal. I just shared a link to all of our upcoming webinars and networking events. Guys, they're free. Join us. But I would love to, in the future, come speak to you guys in person to your group, and even have you guys at some point come on a webinar and speak for Quest. So I've enjoyed it very much. I hope that the audience has gotten something out of this, and I hope that they pick up the phone and call, and we can discuss and see what happens.
Great.
Absolutely. I mean, if they pick up one thing, I think if I picked up more than one, but if pick up one thing, I think it's worth it. Knowledge is power, so go learn.
Absolutely.
Yep. Great.
Right, thank
well,
you.
Thanks everyone. Have a great rest of your night.
Have a great night, everyone.
Bye.
Bye-bye.
Thank you.